Hey everybody, it's Mr. Wagstaff. Cool stuff to talk about today. So today in our unit on economic and personal finance, we're talking about money management. Today we're going to be talking about interest and fees and how they can affect debt and your spending plan and your finances in general. Let's go ahead and get started. So there's a 99.9999% chance you're going to have to use banks in your life. I don't really know of a situation in which you wouldn't, even if you're independently wealthy. These things will still apply to you. So pretty much everybody that I'm talking to right now, you will use a bank at some point in your life. So you have to understand how banks, their interest rates and fees are going to affect you financially. So banks aren't in the habit of just giving away money for free, and they're not really a charity. Even nonprofits need to make money to be able to pay their employees. So how do banks make money? Banks make money by charging interest when they loan out money. Now, where do they get that money from? The money they get to loan out is actually all the money that people have deposited in the bank. So when you deposit your money in the bank, they actually loan that out to other people. It works as long as not everybody goes and tries to get some money at one time. It works. However, the banks charge people interest to loan other people other people's money. And they're called interest rates. So the bank is basically a middleman in between people's money, but it is well regulated. It is insured. You shouldn't lose your money. Learned that in the Great Depression. If you had me for U.S. history, we talked about that in depth. So interest rates are thank you money that you have to pay to banks in order for them to loan you money. So it's a percentage of the principal, and you'll hear that term a lot, the principal, all right? This doesn't mean like a rule. The principal, when it's the loan, is how much money you take out. You're going to buy a house, you take out a $100,000 loan, the principal is $100,000. You go buy a car. All right, and you have to take out a loan for $20,000 to buy a car. The principal is that $20,000. Then there is interest on top of that. All right, so the total amount that you will pay back in interest is the principal, however much money that you took out, plus the interest rate. So if it's 6% per year and you take out $100,000, if you're doing the math in your head, like, all right, 6% of $100,000, that's $6,000, you would be correct. However, it doesn't mean that you will pay back $106,000 unless you're paying it all back in 1 year. That $6,000, that is thank you money that you have to pay the bank. That's the interest. You have to pay them that every year in addition to paying down the principal. And you don't have to stop paying that $6,000 a year until you've paid off the principal. So every year you have to pay them an additional $6,000 for thank you for loaning me this $100,000 as you're trying to pay off that $100,000. When you spread this out over years and years and years, banks make almost like triple the amount of money a lot of times of the cost of the loan in something that's like a house, like 30 years loans. Obviously, if you take out a $20,000 loan for a handful of years to pay off a car, you're not going to pay back $80,000, but you might pay back $25,000 on a $20,000 loan depending on your interest rate. So your interest is based on the percentage, right? So you want the lowest possible percentage interest rate plus the amount of time it takes to pay it back, all right? So that is interest, and the amount of interest that you have to pay on the loans when you need to take them out greatly impacts your finances. So you have to take that into consideration on how much that you're going to have to pay back over the life of the loan. Another thing that will impact you very heavily is bank fees. So fees are basically charges the bank gives you for a variety of reasons. Say you overdraft your debit card. You might get a fee for that because they're trying to cover you because you don't have enough money in the bank. They tried a few years ago to start charging a fee to like use a debit card, and there's usually a pretty big backlash to that, so people stop doing that. But a bank fee is different than interest. A bank fee is literally like they're charging you for a service. Usually fees only come up when you they have a rule saying, hey, we have a rule that if you have a savings account, you have to have $200 in it at all times, and you drop down below $200, they might charge you a fee for having less than $200 in that account, which would then, I know it seems counterintuitive because then you would have less money in the account. But bank fees are usually up front. There's certain rules you have to follow at the bank, and if you don't follow those rules the way they want you to do it, you can incur a fee. If you're trying to make a payment on something, on your house, on your mortgage, and you don't pay it on time to the bank, not only do you still have to make that payment, but when you make it, if it's late, they can charge you a late fee on top of that. So bank fees are extra charges that the banks can charge you that are different than interest. Now, because of that, and the amount of interest rates and the amount of fees that banks charge vary drastically from bank to bank, what you should do is you should compare bank rates. Look at what their interest rates are on loans. Look at what their fees are before you're settling on what bank to take a loan out from or which one to make your primary bank. Because by comparing the cost of fees and interest rates in these banks really helps you keep more of your money in your pocket. So you want less fees, lower interest rates when at all possible. And just because you use one bank as your primary bank doesn't mean you can't go get a loan from another bank. So the question here is, how can individuals reduce the overall cost of borrowing money from financial institutions? And we just talked about that, about the comparisons there. So pause me, answer this completely, and we're moving on. All right, let's talk about fees associated with spending. So, I do want to throw in interest in here again and give you another example of that because interest is a huge part of taking out loans. Fees are typically you've done something wrong, kind of feels like that sometimes. Not necessarily. Like I use the example of having a late fee, making a payment. That is a fee. But there's a lot of fees that come up. That's just how they do business. And they're upfront about them. They try not to have hidden fees a lot of times with banks. That's kind of a no-no, but the banks are usually upfront on their fees. But let's talk about interest here as a huge fee that you pay. So interest is basically the fee that you pay for having a loan. If you take $300,000 on a 30-year fixed mortgage, means you're going to pay out the same price every month for 30 years at 4%, which is actually a pretty solid, I would say exceptional, depending on where the current rates are. 4% is a pretty solid number if you can find 4%. If you pay that off every month at the correct rate that you're supposed to, that means when you are done paying off that $300,000 loan, you have actually paid back $515,000 because you have to pay back $12,000 every year in thank you money to the bank until you pay off that $300,000. So when loans get longer, the interest rate really goes up. The longer you make your loan, the monthly payments seem to go down, but because you're stretching out more years, you end up paying way more than the original price. And the only thing that you should really spend this amount of money on over 30 years is something like a house that typically appreciates, means it increases in value. You wouldn't want to take a 30-year loan out on a car because cars usually don't increase in value, they decrease. So that car will be long gone before you ever pay off your loan. So again, the loan length affects the cost. As you can see that on a $25,000 auto loan, all right, if you take a loan out for 3 years, all right, then you are only paying an additional $1,173 on top of that $25,000 when it's all said and done after 3 years. You take out a $25,000 loan on a car for 7 years, you're paying an additional $2,748 at the end. And again, 3% is a fantastic rate. And we're going to talk about next unit in credit and debt more in detail. And we're going to talk about how you get these lower rates and credit scores and things like that. All right, so let's just talk about some fees that you're probably going to be more familiar with, maybe present day. ATM fees. So if you go to a place that only wants cash, all right, and you need cash, you can either go to the bank and get the money out at the bank, say, hey, I want money. They give it to you. There's no fee there, all right. If you go to an ATM, a machine where you put your card in and say, hey, I want 40 bucks out, there could be a fee associated with that. Sometimes there's not, sometimes there are. So let me walk you through what these fees are. So a lot of banks say, hey, there's no fee for using our ATMs. So like if you go to Bank of America, I'm using them as an example. I don't use Bank of America, so I don't know exactly their format here. But Bank of America might say, it's free to use any of our ATMs. So you go to any of their ATM and you put your card in. They're not giving you like free money. You're getting your own money out of your checking account. But if you find a Bank of America ATM and you have your Bank of America card and that's your bank, you get money out. They're not going to charge you anything extra. Cool. However, say you go to a BB&T bank and there's an ATM there, but you're a Bank of America person and you put your Bank of America card in the BB&T ATM, Bank of America might charge you $3 in order to get your money out of a BB&T AT&T. I'm using all types of companies here. Get out of an ATM. All right. So some banks will be like, you can use any ATM and we won't charge a fee. Those are rare. Usually banks like you to use their ATMs because it's a lot of work to like negotiate with other banks. But let's say you have a bank that's like, we won't charge you a fee ever for anybody that you use. I don't even know if those banks exist. Hooray. That doesn't mean you might not still get hit with ATM fees. This is an example of one. So say you go to a festival or a concert or something and all the, you want to go buy yourself food or whatever, and they only take cash. So you need to go get cash, but you didn't bring any cash with you. So you go to this ATM, but you're like, hey, I've got a card that doesn't charge me fees on anything. And you go to this ATM. Sure, your bank might not charge you an ATM, but this person who owns this ATM that's showing up might charge like a $20 fee to them in order to get your money out of the bank. Even though your bank's not charging you a fee, this person here, whoever owns this random ATM, could be charging you like a $20 fee to get your money out. These type of ATM fees, if you're taking money out all the time, especially in random places, it's much smarter to just go to your bank and take the money with you as opposed to paying these fees at different places. There's another type of fee commonly used called foreign transaction fees. Foreign means in other countries. That if you use your card, all right, in other countries, sometimes even using cash, because they have to switch it over to the money of what other country that you're in, and there's a transaction fee that's associated with that, even though that they're like, all right, well, you're in country A and you have country A money and you need to switch it over to country B money. They will do that, but there's also a fee because you have to pay somebody that's going to switch over that money for you. Most commonly, the things that incur a transaction fee, like from your bank, if you're using your card in another country, are things like buying airplane tickets, going shopping, taking ATM, using an ATM in another country. These things, because it has to go through an entire process of switching the money around, can incur a pretty solid foreign transaction fee. So having your money switched over before you go, buying your plane tickets online in advance, these types of things help limit the fees and extra costs that you can incur if you plan ahead. A lot of these fees can be avoided if you plan ahead for them. There's another concept called a wire transfer. These is less common now that we have stuff like PayPal and Venmo and Cash App, and depending on how many years you're watching this after I'm saying this, there might be like 25 new ones. So wire transfer is the old school way of doing that. Basically, you go to a banking establishment and give them money. They switch it over to another person's bank, and then that bank gives them money. It's a very secure way of sending money to other people. The most famous and commonly known place to wire money to somebody is a company called Western Union. You go there, you swipe your card however much money you want to send, and then they send it to that person's bank, and that bank gives it to them. This is super secure. Once you wire somebody money, you're not getting it back. So this is why fraud and scams and people are like, whoa, wire me the money for, I'm a Nigerian prince and whatever. Wiring money is done. Once you have wired it to their bank, since it's such a secure thing, you're not getting that back. You can't claim I was defrauded purely because, I mean, there is a thing called wire fraud, but that's more criminal charges. You're probably not getting your money back. So be careful when you send it, because whoever you send that money to, they will get that money. So make sure you know who you're sending it to. So wiring somebody money or sending somebody money, this is common when, like, you always see it in movies, like, you know, some 19-year-old kid gets stuck on spring break somewhere, freshman year of college, and is like, oh, I don't have money to get back. And then, like, parents have to, like, yell at them on the phone and then go wire them money so that they can get a plane ticket back and so they can get yelled at some more. This is how they would send them money if they didn't have. Now, again, today we have Venmo, PayPal, these other apps that can kind of circumvent wire transfers, but this is still a huge part of businesses, and it is not cheap. So wiring somebody's money, like, just if you're trying to send somebody money from one side of the country to the other, it could be $15 just to send them the money. So if you're only sending them $5, it might not be worth it. So wiring money, if it, you know, usually it's usually a large amount, and it's a $15 flat rate. So wiring money is a way of directly sending people money. But again, there is a fee associated with it. So if you're sending somebody $200, it would be $215 if it was just domestic, and that's the cheapest it becomes. So the question here is, what is a potential cost associated with ATM withdrawals, and how does that increase overall spending? So pause me, answer that completely. We're moving on. One of the biggest impacts in absolutely ruining any type of spending plan that you have, or your finances in general, is getting in what's called a cycle of debt. Because once you get trapped into a cycle of debt, it's really, really hard to get out of. So cycle of debt basically means that you're in debt, and the more you try to get out of debt, the harder it is to get out. Let me give you an example. And we'll talk about credit and credit cards more in the next unit. We start talking about credit and debt. But I wanted to go ahead and give you kind of an overview here of one of the most dangerous things that is associated with your spending plan, and it's a cycle of debt. So when you use a credit card, you're actually using other people's money. A debit card comes out of your account. Credit card is you're using somebody else's money, Visa, MasterCard, and you get a bill at the end of the month and you have to pay anything you spent on that credit card with your own money at the end of the month. So as you're just swiping this card, nothing's coming out of your account. People that don't keep good records of that end up spending more money than they can pay off. So what happens is if you can't pay that off at the end of the month, then you pay off what you can, and then it carries over to the next month. However, that's when interest starts getting applied. And we talked about the differences, showed you a little bit like 4%, 6%. Credit cards can have like 27% interest. It's astronomical. Credit cards, while they offer you all these benefits, and we will talk about in the next unit, they're also in business hoping people can't pay them off, because then you get trapped in this vicious cycle of debt. Because with credit cards in particular, once you get into debt, all right, you are trying to pay your way out of it. However, unless you can just pay it all off immediately, that debt just keeps rising. Oh, you may not even be spending the credit card anymore, but the amount of money you owe just rises as you're trying to pay it off, because they have these super high interest rates. If you never got into debt and you just paid credit cards off every month on time, there are benefits to it. However, if you get behind on credit card payments, it can start stacking up really quickly and absolutely ruin any type of spending plan and lifestyle that you had. So you start getting fees, interest rates, and this is not a unique special scenario. This is is it 2008? Did I see that? This is from 2008. I see a 2006 up here. So this was a while back. $972 billion worth of credit card debt in the United States, and this is in 2008. I guarantee it's well over $1 trillion now. that's like imaginary money. Like you can't even comprehend how much money that is. So of that almost trillion, 2.1 trillion was spent, which means like almost half of the amount of money spent on credit cards is in late fees. The credit cards and getting in this debt is really hard to get out of, because once you get into credit card debt, the debt just keeps piling on top of each other because the interest rates keep rising, and that's what a cycle of debt is. So the more you're trying to spend to get out of credit card debt, the less disposable income that you have. So, but you have to buy something. How do you buy it? Use the credit card. Adds to the balance. This is where the cycle of debt comes in, and it is very, very common with credit cards. And it is very hard to get out of. The absolute best way to not to defeat this cycle of debt is to never get into it in the first place. It's like a whirlpool. Very hard to get out of when you get into it. So the question here is, what is a cycle of debt and how does it happen? So pause me, answer that completely. We're moving on. All right. Let's talk about the good and bad of interest rates. So we have talked about interest rates and probably scared you with interest rates. So interest rates is basically thank you money for allowing you to borrow money, like in a loan. That's going to have an interest rate. Using credit card, which is other people's money, that's going to have an interest rate if you don't pay it back immediately like that month. So there is good and bad interest rates. And you're like, well, what's a good interest rate? You're talking about a low interest rate? Specifically here, I'm talking about interest rates that work for you. All right. So this is a lot how 401ks work. Insurance companies kind of work this way on their end, is that when you put money into an account, all right, like a savings account, a high yield savings account, you invest it somewhere else, like a 401k for retirement, that you get interest because you're basically loaning them money. So they give you thank you money called interest. Cool. All right, get a little bit of money here and there every month. Like, cool, adds to it. Now, here's where interest is really cool. All right, that can work for you. There's something called compound interest. If you put your money into an account and you don't touch it, and it's just a savings account, and you keep putting money into it, you keep getting a little bit of interest. However, that little bit of interest, because it's constant all the time, starts growing. So, all right, so that gets added to the existing amount you've put in. When you get interest, which is based off how much money is in that account, once you have a substantial amount of interest coming in and that it's been there for a while, your interest is based on the amount of money you put in plus the interest you've already occurred in there. So you're getting interest on top of interest, and that's called compound interest. And it's almost like things start doubling like quickly. So everything starts out slow for quite a while, and then it kicks up, and your money will start growing very quickly after it's been in there for years. So compound interest is a way of having interest work for you. And that's why I talked about early on in this unit, setting money aside in savings early at all possible is such an important aspect of being financially responsible, because you're not going to be able to work your entire life. And you're going to want to be able to retire and put money aside in things like a 401k, in which you can start getting that compound interest. So by the time it's time to retire, you can live the same lifestyle you lived your whole life without having to work at all anymore. Now, and we've mentioned this, and this should be completely, you should know how to do this now. But I need to once again explain to you how interest works on a loan. All right. So the principal, all right, is the amount of money you're taking out. You're going to buy a car, $20,000. That's your principal. They give you a loan for $20,000. All right. How much do you pay back? Well, it depends. Obviously, you're going to pay back that $20,000 plus whatever the interest rate is. So here, and I'll use their example. If you take a loan out for 1 year, all right, and it's a $100 loan at 6% interest, and you pay that back over the course of a year, the total amount of interest you have to pay back is $6, which gets added to the principal, which is $100, and you'd pay back $106. If you paid it back over 2 years, all right, That is 6% of that $100 per year, which would be $12 because it's 2 years, and you would end up paying back $112. So to calculate your loan interest, it is the amount of interest, what your interest rate is, times the amount of years that you are going to be paying it back. So the longer you make a loan, the more you will pay back in the end. All right, so the question here is, how can high interest rates and savings on savings accounts impact savings? So pause me, answer that completely. We're moving on. All right, so let's talk about managing your interest and fees. Number one way to not have the cycle of debt and all these other things, and this is pretty much kind of a golden rule with your finances. Pay your bills on time. This is how you manage fees. This is how you manage these different costs associated with money. When you borrow money, pay it back on time at the agreed upon rate. So pay your bills on time. Because if you don't, it starts adding up very quickly and increases debt. So if you're paying it off on time and you're paying even your credit cards, if you're paying it back on time, it keeps your debt low, all right? It helps you eliminate debt. Getting behind on your payments, however, all right, then you start getting late fees and extra interest added to it, and that's when you enter that cycle of debt. Paying your bills on time is like the golden rule for staying out of like financial Armageddon. There's a lot of other rules as well, but paying your bills on time and not saying I'll get to it next month, that is like the worst possible thing that you can do. Paying your bills on time allows you to pay down your debt and stay out of debt and effectively manage your finances. So the question here is, how can making payments on time impact debt? Just talked about it. And I should point out, most people are in debt. Debt isn't necessarily bad. People will have to take out loans to go to college. People have to take out loans to buy a car. People have to take out loans to buy a house. And those are things you pay back over time because you couldn't afford them at the time. You couldn't afford, a $200,000 house. You had to take a loan out to do that. So debt itself isn't necessarily catastrophic. However, having a spending plan in which you're getting yourself out of debt and you're paying it off on time is wildly necessary. Because not paying your bills on time is just going to compound your debt and put you right into that debt cycle. So, pause me, answer that completely. That's what I got for you guys today. See y'all tomorrow.